Welcome back to the Deep Dive. Today we're tackling the latest from Goldman Sachs, their third quarter 2025 earnings release, and the presentation that went with it.
Yep, big stack of documents.
Right. And our job, as always, is to sift through it all and, pull out the main story. What's the why behind the big numbers?
Get straight to the point.
Exactly. We want to give you the quick path to understanding what really drove things this quarter, especially across the different business lines.
And, well, if you just need the absolute top line, it's strength. Real strength and solid execution. This wasn't just okay.
No.
No, the sources show this was actually the third highest quarterly net revenue performance in Goldman's entire history.
Third highest ever.
Wow. Yeah. And the year-over-year growth compared to Q3 2024, it's pretty staggering.
Yeah.
Net revenues hit $15.18 billion. That's up 20%.
Okay.
Net earnings, $4.1 zillion. It's a 37% jump.
37.
And diluted EPS, earnings per share, landed at $12.25. That's up a massive 46% from last year.
Wait, those are some serious numbers. Definitely suggests a turnaround, or at least, like you said, a much better market environment, particularly for banking activities.
Right.
And the commentary from CEO David Solomon seemed to reflect that confidence too, didn't it?
It did. He basically said the results show two things. The strength of their client business, their franchise, and second, that they're really focused on executing their strategy.
In this improved market.
In this improved market, yes. And he also looked ahead, talking about operating more efficiently. And interestingly, he specifically called out being aided by new AI technologies for that.
Ah, the AI mention. We hear that a lot these days.
We do, and it's something to, keep pinned, especially when we get to the expenses later. We need to see if that efficiency is actually showing up yet.
Good point. Okay, let's start with the main engine then. Global banking and markets. GBM. Still the biggest piece of the pie, right?
By far. It brought in $10.12 billion in net revenue. That's up 18% year over year.
18%. And it looks like the driver wasn't just, say, wild trading volatility. It was the investment banking side really kicking into gear.
Absolutely. Investment banking fees were $2.66 billion. That's up a huge 42% compared to last year.
42%. That's enormous.
It really is. And the story within that is about the big, complex deals coming back. Advisory fees, M&A advice, they were up 60%. 60.
Wow. Just from M&A.
The sources tie it directly to a big pickup in completed M&A deals, and they highlighted that Goldman ranked #1 in both announced and completed M&A for the period.
Okay, so when deal-making heats up, Goldman benefits. That seems pretty clear.
It's their bread and butter.
But it wasn't just M&A, right? The capital market side underwriting also looks strong within that 42% growth.
Very strong. Debt underwriting was up 30%. The report says that was mostly driven by leveraged finance activity.
Okay, LBOs and that sort of thing.
Exactly. And equity underwriting had a good showing too, up 21%. That was helped by IPOs, initial public offerings, making a bit of a comeback.
Welcome sight, even if maybe not back to peak levels.
Right. Not peak levels, but definitely better. Now, what's kind of interesting is that even with all this deal closing activity, their reported backlog, the pipeline for future deals, was apparently essentially unchanged from the previous quarter.
So they executed really well on what was already lined up, but the pipeline for Q4 didn't necessarily swell dramatically.
That seems to be the takeaway. Great execution quarter, steady pipeline going forward.
Okay. Let's shift within GBM to the trading side. FICC, fixed income, currencies, commodities. That came in at $3.47 billion, up 17% year on year. Looks like a solid number, but maybe driven by specific areas.
Yeah, definitely specific. That 17% growth in FICC mainly came from intermediation, basically, handling client trades, specifically in things like interest rate products, mortgages, and commodities.
So where their big institutional clients were active.
Precisely. But like you hinted, the report also notes significantly lower revenues in currencies and also in credit products.
Okay, so the headline number is good, but it's masking some weakness. Or just concentration.
I'd say concentration. Strong in rates, mortgages, commodities. Less so in FX and credit this particular quarter.
Got it. And then equities. That was $3.74 billion, up a more, let's say, modest 7% year over year.
Yeah.
But I saw something interesting there about financing revenues.
Yes, that's a really key point. They reported record equities financing net revenues.
Record levels. And that's driven by
crime financing, which, just to clarify for everyone listening, that's the lending and margin services they provide mostly to hedge funds and other big institutional clients. It's more of a steady fee-based business linked to the assets they service.
Right, less about daily trading swings.
Exactly. And that strength in prime financing was actually strong enough to completely make up for significantly lower revenues in equities intermediation, which is the more traditional trading of cash stocks.
So that really underlines a shift, doesn't it? Making record money from financing client assets, this stable scale business, even while the actual day-to-day stock trading part was softer.
That's a perfect summary. The revenue engine is definitely leaning more towards those reliable, large-scale financing streams.
Okay, let's move to the second major division, Asset and Wealth Management, AWM. This is the part focused more on, stability, fees, long-term capital. How did it do?
Very solid. $4.4 billion in net revenue. That's up 17% compared to Q3 last year.
17% growth there, too. Nice. What's the key metric driving that?
It's really assets under supervision, or AUS. They hit a new record, $3.45 trillion.
$3.45 trillion.
Yep, and that total was up $159 billion just in this one quarter.
Okay, $159 billion increase in 3 months. That's huge. Was that just markets going up, or did they actually attract new money?
It was actually a really healthy mix, which is quite impressive. About $80 billion came from markets appreciating, stocks and bonds going up.
Okay, about a half.
Right. But crucially, the other $79 billion was from total net inflows. That's new client money coming in the door.
$79 billion in new money.
Yeah, across all the channels, institutional clients, third-party platforms they work with, and their own wealth management clients.
That suggests pretty strong client confidence, maybe people seeking stability or liking their alternative offerings.
I think that's fair to say. Strong inflows usually signal confidence in the platform and the strategies, especially in attracting that high net worth money and flows into alternatives.
Speaking of specifics, I saw a detail in AWM about private banking revenues jumping quite a bit, like 40% year over year.
Yeah, that was an interesting one. That specific jump, according to the notes, was mainly because they received interest payments on a loan that had previously been marked down or impaired.
So more of a one-off recovery than underlying business growth.
Primarily, yes. A nice bump, but maybe not repeatable every quarter. It does show how sometimes those older assets can pop back up positively.
And on the alternative side, still a focus.
Oh, absolutely. Alternative investments AUS went up $19 billion to $374 billion total. And they mention raising $33 billion in new third-party money for alternatives during the quarter. So, yeah, definitely still a major push there.
Okay. Now, for this segment that always seems a bit complicated, Platform Solutions, PS. This includes some of the legacy consumer stuff they're winding down, right?
Exactly. And the numbers look kind of wild at first glance.
Yeah, revenue was $670 million, which is up a massive 71% compared to last year, 71%. But the segment still lost money, a pre-tax loss of $39 million.
Right. And this is where you absolutely need the context, that 71% growth isn't what it looks like.
Not organic growth.
Not really, no. It's because the comparison period, Q3 2024, was artificially low. That's when they took big losses and markdowns related to transferring the GM credit card business and some seller financing loans to held for sale.
Okay, so the comparison year was terrible because they were actively writing things down to get rid of them, making this year look amazing by comparison.
Precisely. It's more about the absence of those big losses this year than it is about some sudden boom in the remaining platform businesses. It shows the cleanup is progressing, I guess.
Gotcha. That makes way more sense. And this cleanup, does it give us a clearer view of the credit risk still sitting on their books?
It does. If you look at the overall provision for credit losses for the whole firm, it was $339 million. That's actually down 15% from last year overall.
Down 15%. So where are the provisions they're taking concentrated?
Well, the report says the provision primarily reflects Net's provisions for the credit card portfolio, driven by charge-offs there.
The remaining consumer cards.
Exactly. And here's the really telling part. Look at the annualized net charge-off rates. For their main business, wholesale loans to big companies, the rate was incredibly low, just 0.1%.
0.1, basically nothing.
Almost nothing. But for the consumer loans, the annualized net charge-off rate was 5.6%.
5.6%. Whoa. Okay, that really highlights the difference. The risk is clearly ring-fenced in that consumer portfolio they're trying to manage down?
Absolutely crystal clear. It's not a firm-wide credit issue. It's very specific to that legacy consumer piece.
Okay, so performance was strong overall, but how did they manage costs? Operating expenses were $9.45 billion, up 14% year over year. That sounds like quite a jump, especially with that talk of AI efficiency earlier.
It is a jump, and the drivers are kind of a mix of good news and, well, just the cost of doing business at this scale.
Good news being higher bonuses.
Partly, yes. Higher compensation and benefits definitely contributed, reflecting the better performance. Higher transaction-based costs, too, which makes sense with more activity.
Okay, paying for performance. What else?
Well, they noted higher charitable contributions to Goldman Sachs gives, but the really significant jump was in provisions for litigation and regulatory proceedings.
Ah, the legal and regulatory stuff. Always a factor for big banks. How big was that increase?
It was pretty dramatic, actually. The net provisions for litigation were $131 million this quarter.
Okay.
Compare that to just $41 million in Q3 of 2024.
Wow, from 41 million to 131 million. That's more than triple. That's a huge swing factor in expenses.
It really is. And it just highlights how even when the core business is firing on all cylinders, these unpredictable costs can really bite into the bottom line and, offset some of those hoped-for efficiency gains.
Yeah, that makes the AI efficiency goal seem even more challenging if these kinds of costs can spike like that.
It sets up a definite tension. Okay, just wrapping up the financials. Capital looks strong. Book value per share grew 1.2% in the quarter, up to $353.79.
Solid. And shareholder returns.
Pretty generous this quarter. They returned $3.25 billion to common shareholders. That was $2 billion in share buybacks. They bought back 2.8 million shares and $1.25 billion in dividends. They declared a $4 dividend per share.
Okay, so shareholders definitely participated in the strong results.
They did.
So if we try to boil this whole deep dive down,
Yeah.
the main story seems to be investment banking had a fantastic quarter, M&A is back, asset and wealth management is steadily growing, pulling in serious client money. And that platform solutions consumer situation, well, the risk is obvious in the charge-offs, but it looks contained, and they're managing it down.
That captures it really well. Investment banking roaring, wealth scaling nicely, consumer being dealt with. But
There's always a but.
well, it circles back to what we discussed at the start. The CEO is talking up long-term efficiency, highlighting AI. Yet this quarter, operating expenses jumped 14% year over year.
Driven by pay for performance, but also that big spike in legal and regulatory costs.
Exactly. From $41 million last year to $131 million this year. So the provocative thought maybe for you, the listener, is this. As Goldman pushes this tech and efficiency narrative, how long will it actually take for those AI gains, whatever they might be, to genuinely start outpacing these rising costs? The costs tied to good performance, yes, but also the costs of just operating in today's complex regulatory world.
That's the key tension, isn't it? Can the tech efficiency really bend the cost curve when performance-related pay and regulatory expenses keep climbing?
That's what we'll need to watch in the coming quarters. Can that AI promise actually deliver tangible results against those operational headwinds?